My name is Matthew Boersen, and I'm the managing partner here at Straight Path Wealth Management. I wanted to talk a little bit today about the year that is coming to a close, 2022, and kind of the crazy year and the crazy storylines that we saw over the last 12 months. It's been a year that's seen a lot of market volatility, a lot of geopolitical stories, as well as a lot of economic changes that we think will have a big impact, not only through the last couple weeks of this year, but also going into 2023 and beyond. So we've come up with three themes that we think encapsulate 2022 really well and the effect that it had on the investment portfolios. There's a lot of things that could have been added. There's a fourth, fifth, and sixth story certainly out there, but these are the three kind of key things that we want to focus on that'll also then lead us towards what we're looking at into 2023. So first, our first key theme for 2022 was inflation. This was something that we talked about constantly over the course of 2022. And you can see kind of the last 12 months here and kind of the trend of inflation. These are numbers that we would have never dreamed of seeing 10 years ago when inflation was consistently running at only 2 or 3%. Starting at the end of last year in November of 2021, inflation started to get above 6%, 7%, and then hit its peak in June of 2022 when it reached nearly 9% in the United States. What's happened since then is inflation still has absolutely stayed elevated, but it seems that maybe it's starting to trend down just a little bit. Our most recent reading for November of 2022 was 7.1%. Still an astronomically high number, but something that you can see through the trend, it maybe is starting to get under control, maybe is on its downward trend back towards normality, which is an exciting thing. Because when we look at investment portfolios, when we look at retirement planning, inflation is one of the things that we are always most concerned about. Inflation is something that doesn't come back. If the market drops, typically the market comes back. When we get higher prices, those elevated prices tend to stay. And just future inflation, even once it gets under control, just builds off of those higher prices. And so inflation has a huge impact on retirement planning, has a huge impact on investment returns. And so it's something that really carried a major storyline for 2022, and not a good one. It was overall a really negative story, but one that we're hoping maybe gets under control as the Federal Reserve has been really aggressive with raising interest rates, and we're starting to maybe see the trend downward. At least we hope so. And so in pair with that, what I just mentioned then was interest rates. And so interest rates are our second storyline of the year. Interest rates changed radically since the end of last year. For really since 2008 to 2009, interest rates have been consistently low in the United States, with U.S. Treasuries consistently returning less than 2 or 3%, money market accounts yielding less than 0.5%, and you getting absolutely nothing in your checkings and savings accounts. We fast forward 12 months, and the interest rate world is very, very different. Interest rates have gone up significantly, largely because the Federal Reserve has increased interest rates to try to control inflation. But you can see the 10-year the U.S. Treasury yield curve here. And what this is showing us is the different maturities or the different interest rates that we get at different maturities along the U.S. Treasuries. This doesn't show corporate bonds, but corporate bonds have a similar shape. And what you'll notice first is the gray line there is 2021. The blue line is 2022. So the first thing to notice is just a huge shift upwards where most interest rates more than doubled, and in some of the maturity dates, tripled or quadrupled. The other thing that I'd point out is the difference in shape. So historically, you have what's called an upward sloping yield curve. So in 2021 and for most historical time periods, you see shorter maturity bonds. So on the far left, so 3-month, 1-year, 2-year, typically yielding less than the longer term than the longer term maturities. So think the 10, 20, or 30 years. That's been the case long term historically. That was the case through most of 2021. That is obviously not the case now. We have this kind of weird shape where the far left side of the curve is significantly higher than actually the right side. Part of that is the prediction that, hey, the Federal Reserve is going to continue to increase interest rates, trying to make sure that we continue to get inflation under control. But what it also means is that what the yield curve also is showing us is that they believe that the Federal Reserve is going to at some point have to drop those interest rates due to the fact that A, hopefully they get inflation under control, and B, to hopefully offset what could be a little bit of an economic slowdown. And so the interest rate curve is telling us a little bit of a prediction of the future. That they still think we'll get back to maybe not as low as what our rates were through 2021 and for the few years prior, but getting back to somewhere in that 3 to 4% range, which historically has been a pretty good average for where interest rates need to be. A positive of this storyline is that this means that we're finally earning some money, finally earning some interest on safe investments. So on bonds and money market accounts and in your checking and savings accounts, finally we're starting to get some decent interest where for the last decade it was a struggle to even get 1 or 2% in some of those types of investments. And so this is maybe the silver lining of maybe some of the other stories, certainly of the inflation story and of the big picture of interest rates, is that we're starting to get more in some of those safer investments. And this actually does help retirees. This is something that does help retirement plan and financial planning. And this helps offset at least a little bit the impact of inflation as we're getting higher interest rates on some of these investments. And so this has some good pieces to it. It has some negative pieces to it. But overall, this is something that we feel like we can take advantage of big picture inside investment portfolios. And then third is the decimation, truthfully, of tech stocks and cryptocurrencies so far this year in the stock market. And so we've seen the entire stock market drop. We've seen the entire stock market have a lot of volatility, but it really is only a fraction compared to what we've seen in tech stocks and in cryptocurrencies. And so here you can see 6 different kind of measures and 6 different performance levels. These are all levels of losses. So the first one is Meta, which most of us understand as Facebook, has lost over 60%. Zoom, the company that was just the light of the world during COVID and everyone thought was going to be the next big company, has really struggled this year. Even Amazon is down 50%. Tesla and Peloton have been down even more. And then Bitcoin down over 60% so far in 2022 as well. And if we look at some of the other cryptocurrencies, those are down 75% or more. And so thankfully, from our portfolio strategy, while we have some exposure to some of those names in some limited capacity, it's one of the benefits of staying diversified. Many of these names were some of the highest flying names in 2020 and the beginning of 2021, and are now some of the ones that are at the lowest level of performance, even when we look back over a 2 or 3 year time span. So making sure that we stay with our strategy, making sure that we're consistent, making sure that we stay diversified remains important. And we've seen that come true certainly in 2022. So now what we're looking at with this is we're looking at, all right, what industries are attractive going into 2023? We'll talk about that in the next couple of weeks coming up and as we meet with you guys individually. But this is a good picture and a good snapshot of what we've seen so far. And our 3 main themes, again, inflation being really, really high, hopefully maybe on its way down, interest rates increasing, which actually could help offset a little bit of the impact of inflation, and then tech stocks and crypto really getting hammered so far in 2022.